I'm Lee McDarby. I'm Managing Director of Moneycorp UK, and I'd like to welcome you to the webinar today, brought to you by Moneycorp Bank. Today on our webinar, we're going to be discussing the topic of Brexit. Moneycorp Bank exists to help businesses, individuals and banks thrive internationally when it comes to moving money across borders. Our two esteemed guests today on the webinar are Vicky Pryce, who's a business and economic expert and also former joint head of the UK Government Economic Service, and Charlie McCreevy, former Irish politician and European Commissioner for International Markets and Services from 2004 to 2010. Welcome to both Vicky and Charlie to the webinar today, brought to you by Moneycorp Bank. I'm going to dive straight into the first question, which is definitely the question that has been on everybody's lips, certainly for the last few years, when it comes to the notion of how exit from the European Union will be achieved by Britain. So the question is, Brexit seems to have been both in and out of the limelight throughout the course of this year. However, now we have less than 30 days to go until transition period ends. And in your view, is a deal likely to be reached?
Well, perhaps I can start and say yes. I think it will be reached, mainly because the impact of COVID has been so significant on growth. I don't think the government can really afford to have more negative influences on what happens over the next year or two. I think Boris Johnson needs that growth to come back. With debt having increased so significantly, it is really only growth that will reduce the debt to GDP ratio at some point in the future. And therefore, I think it is now imperative for a deal to come, so that despite the fact that it will still be negative for growth overall, it isn't going to be as negative as would otherwise be the case. And we've seen that reflected in quite a lot of the forecasts that have come out recently, whether it's from the Bank of England or whether it is from the Office for Budget Responsibility, which accompanied the recent spending review, which did try and put some estimates of what the impact of no deal might be on the economy. And their estimates for next year is that no deal may lead to 1 to 2% less growth in GDP than would otherwise be the case. And that would be on top of the 3% that has been calculated so far, the impact of Brexit to have been on growth, if you look at what happened with the economy since 2016 when we voted to leave the EU. So an imperative, I think, for that to happen. And that is without saying anything about what businesses would like to see happen. I think the government needs the growth, and a trade deal would at least give them something and not the sort of lower growth, the extent that would otherwise be the case if we had no deal.
Well, I also believe that there will be a deal. That is, if you only force me up against the wall. But I wouldn't prejudge that there may not be great difficulties and standoffs and sit-downs or walkouts, because that often happens at the end of negotiations. But just as Vicky has said, I think it is too difficult for both sides to contemplate that there wouldn't be a deal. Vicky's outlined what the UK negativity on their GDP will be the absence of a no deal, on top of the COVID crisis, which is leading to a lot less growth in the United Kingdom and everywhere else for that matter also. So to add a no deal on top of that would be, I think, it is too much for kind of the politicians to be able to consume. On the other hand, haven't been in the UK now since last March, but I was there a lot over the last, say, 20 years or so. I think the majority of the population, particularly that side that voted no in the referendum, don't seem to appreciate that when the Chancellor last week said that would lead to no deal would lead to even less more negative growth in the forthcoming years, and that greatness and the quantum of the national debt of what will have to be done. I don't think that impinges too much on the people who are on the no side. And it's also going to be linked with the difficulties from COVID. I think the political, also from the EU side, you must remember, a no deal would be very bad. The fact that Britain is leaving is bad for both sides in any event. But it should not be forgotten that from the EU side, and particularly from the Irish side, no deal would be the worst of all possible worlds, coming on what we've suffered from COVID in 2020 and into the future. So yes, I think that there will be a deal, but the outstanding issues are still there. I find it hard to believe that the three issues that have been signalled in the newspapers would, well, at least one of them would lead to a collapse. But there seems to be, from the UK side, very strong negotiation difficulties with the three issues. One was fisheries, which Vicky will be able to tell me the percentage that contributes to UK GDP. It's minuscule, but it's very important in terms of these negotiations. The state aid level playing pitch is a big issue for the EU because they don't want to have a big neighbour with differing rules, etc., etc. And the third thing seems to be governance. In other words, who's going to, what body is going to determine when someone breaks the rules? Now, my former boss, the Irish Prime Minister, Bertie Ahern, the Taoiseach, who has served in government as Minister of Finance for a long time with him, and before I went to the EU, he said quite recently is that he thought the biggest issue from the UK view was actually the governance. Right? He went to the UK quite a lot, and he thought with the Brexit side, particularly some of the ministers, that the fact that the European Court of Justice could have any role at all in determining these matters, he would place at a higher level than the other two areas, which have been more spoken about in the press than anything else. So yes is the answer to the possibility of a deal. I say the same as Vicky.
Vicky, what do you, on the sticking points which Charlie's outlined, what do you think concessions will have to be made to get us to the deal?
I think the governance issue is an important one that Charlie mentioned. But of course, in addition, we have the whole fishing area, the rights and quotas that perhaps can be given or allowed for EU fishermen to fish in or use as quotas for the future, because of course, that would have to be changed, and the UK is insisting that we have the right to fish in our own waters, and whatever quotas we give to the rest, it will be our decision, whereas the EU is actually trying to get quite a substantial percentage of those quotas given to them. And also there's a question of how frequently, perhaps, you review those quotas. And there's a suggestion from the EU that whatever we agree right now needs to be fixed, but then perhaps reviewed in 10 years' time. I think the UK would like that review to be done a bit more frequently, particularly if it's not very good to the very beginning. So there is that element of it. And of course, everyone is scratching their heads and wondering why fishing is so important, but it seems to be very political rather than economic, since fishing accounts for a tiny amount of our economy. And the other one, of course, is the level playing field. In other words, are we allowed to subsidize our industry the way we'd like to, or are we going to be bound by any state aid rules? Not necessarily the rules, of course, since we're not going to be in it, but certainly the idea, the principle behind not subsidizing sectors in such a way that gives us a competitive advantage by comparison to companies in the EU, which might be a real problem for some countries in particular. Well, the reality is, when you look back at what the UK had done, I think it's fair to say that quite often the EU state rules were used as an excuse for not actually supporting any firms or sectors Absolutely. By the UK. And also, if you look at the percentage that is being spent on state aid or things that are deemed to be state aid by other countries in Europe, we have been way behind in those sums than our similarly sized competitors. So it's not really an issue, but it's still more of a taking back control issue, more a political issue than anything else.
Well, I certainly agree with Vicky, because in my experience of being an Irish politician and minister for a long time in various departments, apart from being in the Department of Finance, is that Irish governments, the same as UK governments, use the state aid rules of the EU for not being allowed to subsidise some industries, even though the case against subsidising were strong and the government didn't want that, which I was member wouldn't have wanted and have done it in any event. So we use the EU, and I'm sure the UK was did the exact same thing, because some of the cases we put forward didn't have very little economic argument. Funny enough about the state aid rules, the UK position traditionally, now you can go back a bit further and say when there was a very strong socialist government in the UK in the 60s and 70s, but since the Thatcher time, the UK would have been the least country in the EU, in my view, to jump in to support any type of industry and took a very hands-off approach. The other countries in Europe, particularly France, have a very statist approach to these type of matters. So it's kind of a paradox to me that now with the negotiations that everyone is worried about what the state aid rules might be in the UK as of what they might do. That has not been the position in the past 25 or 30 years. In any event, I would look at it from another viewpoint altogether. So it's, but as Vicky has rightly said, it's more political. And you must remember, from looking at the UK politics, you can see where Mr. Johnson is going to claim a victory no matter what is the outcome of all this. That's what politicians do. I don't have any problem about that. On the other hand, Mr. Macron is in quite a difficult position, particularly to do with fisheries, because the French farmers and the French fishermen are very, very strident when they go about protests, etc. There are elections coming up in France. They'd be very conscious of that. So it's a big issue for France. And just as a by the way token, when we joined the European Economic Community, as it was then in 1973, we traded away our fishing rights, more or less, which is still a sore point with the fishermen around Ireland. We actually, the waters around Ireland are far more vast in the Atlantic than even around the United Kingdom. So we traded away a lot because in order to get another deal. So the fishermen in Ireland would have been very aggrieved and have been for the last 40 years about this particular matter. But like that's what you have to do in negotiations. So, but it's become very, very political, and both sides want to be able to claim credit. But in all negotiations, you have to come to a compromise at some stage.
Well, I guess on the point of fisheries, one of the issues there is where do you draw the borders when it comes to fisheries? I think an area where we know there is a clear border is Northern Ireland, and with the Northern Ireland Protocol due to come into force from the 1st of January 2021, how will this agreement impact trade relations and processes? And furthermore to that, with what's happened in the US recently with US elections, Joe Biden getting into power and his stance on the agreements in Ireland, specifically the Good Friday Agreement. What do you think what impact do you believe the Northern Ireland Protocol is going to have, Charlie?
Well, we during the referendum in the United Kingdom, a lot of people here looked very somewhat amazingly saying that during the whole debate, I don't remember any of the Northern Ireland issue coming up in any debate in the UK. And I would have looked at, I think, nearly every debate there was in the UK, Newsnight and all the other programs. It was not an issue about Northern Ireland. And then when it happened about it became the sticking point. And there have been all types of efforts trying to get over this particular sticking point. Then Mr. Johnson, on behalf of the UK government, entered into an illegal agreement last year, which was said what we're going to have, like no border in Ireland. They'll have to deal with all these things. The island of Ireland will be one place for trade, etc., etc. And then less than 1 year later, he goes before the British Parliament, brings in a bill which breaks an international law. So therefore, there is a very jaundiced view among the negotiators as to how we're going to copper-pass the deal that's not going to be broken willy-nilly. Now, I'm not the only person in Ireland saying that. You'll see a lot of the UK Tory party, particularly those in the House of Lords, went against that particular bill for those reasons, that the UK, of all countries in the world, cannot be seen to break an international agreement, particularly one they entered into less than 12 months earlier. That being said, I think there's a naive view in the whole debate that all of a sudden, when you're out of the EU or whatever, you can just click your fingers and go off and have a deal, say, with the United States or with any country in the world. Trade deals take an inordinate amount of time to negotiate, like an extraordinary amount of time. Like I was Minister for Trade at one particular time in the Irish government, and I was there at the end of the agreement that we signed in Marrakesh, which took something like 12 or 14 years. That was the one in 1993 or 1994. It took that length of time to negotiate the World Trade Agreement. And individual trade agreements don't usually take that length of time, but they take a lot of time. So therefore, doing a deal with the United States and the UK is not going to be click your fingers and there will be a deal. And irrespective of who's in power in the United States, it has to be ratified by Congress. And Congress have made it quite clear before Mr. Biden was elected, or he hasn't assumed office yet, but assuming that he will assume office, is that anything that would imperil the Good Friday Agreement will be a no-no for the Democratic Party. And I think that is a strong conviction among a lot of politicians in the United States. So it became an international issue. Now, I don't think when the EU are sitting down this week with with UK government, that's going to be uppermost in their minds. But it is a factor which will have to be brought into future negotiations. For far as Ireland is concerned, United Kingdom is still a major trading partner for us. So therefore, if there are any type of obstacles in the area of free trade, that is bad for the Irish economy. But we decided a long time ago that our strength lay in siding with Europe, and because we have bigger markets to get along with there, and we're a willing participant in that now. So therefore, there will be, if there is, even if there's some type of a deal, the fact that the UK is leaving is a negative, both for the EU in total, for the UK, but especially for Ireland. So no matter what way we try to dress it up on both sides of the pond, it is going to impact. Now, what extent all this will affect the Irish economy is there'll be various debates about it and figures thrown around. It will have a negative impact somewhat, there's no question of that. But how great it will be, I just don't know. But one thing is that we will not imperil, and neither will the United States Congress imperil the Good Friday Agreement. So yes, it is a factor. The extent that's bearing down on the negotiators this week or last week, or whether finalise the deal, I just don't know. But it has some consequence.
Can I just add quickly that, of course, I mean, Charlie's absolutely right. The free trade agreements or trade agreements of any sort take forever. Interestingly, the UK has been talking about a Canada-style agreement. Of course, that started being negotiated in 2009. It was finally agreed in 2017. It still then had to go through all those EU countries. So we're talking about a very lengthy process. But of course, we're starting from a position where we have a deal and we're just moving out of it. So it shouldn't take quite so long. But the really important issue is that it does not really generally, even the Canada one, cover services. And that's a big issue for us. Obviously, if one were to worry a little bit about sectors, then that's a really important part of it. So first of all, the time it takes and what it actually covers. But the impact on Ireland and why we absolutely need to have an agreement is indeed expected to be very significant. If you look at which countries are going to be affected most, it's quite interesting. It's Ireland and the Netherlands. The Netherlands seems to be exporting tons of stuff to us, including flowers and all that sort of stuff, tulips, but also dairy products. And that's important. But if you just look at one particular measure, which is the sort of percentage of a country's output, which is then destined to come to the UK, and it comes into the UK as either an intermediate good or a final product or a service. In Ireland, it's almost 10% of its GDP. So that is massive. And if that is the case and that gets disrupted in any way, it has repercussions all across. Of course,
yes. Well, that is a factor. One of the reasons that when I was the EU Commissioner for the Internal Market and Services, and the single market was actually Margaret Thatcher's brainchild. And the idea of the internal market, the free trade, was actually Thatcher was the person who galvanized the whole EU to go down that particular route, which led to all the negotiations after that and led to the greatest single market. And also led to a freedom in financial services in particular, which I don't think the people in France or Germany thought maybe we'd have a free market in financial services, that maybe France and Germany would do better than the United Kingdom. But actually the place that did best was London. in my view, for obvious reasons. That's where the expertise has been for a couple of 100 years, and naturally they benefited more. And it has been a major contributor to the United Kingdom economy, financial services. And therefore, that's going to be a big negative for the UK leaving the EU, because as you probably are aware, that in the City of London, a lot of companies have been making arrangements in order to have EU passporting rights of financial services that they have been setting up in other locations, etc., etc. So it's a bit of a, it's supreme irony is that for the UK to be leaving, having been the best contributor and galvanizing the whole concept of a single market, an internal market and everything, which led to a whole lot of negotiations, a whole lot of different rules, because you can't just say tariffs are not the only thing about the single market. There are all types of rules, regulations and impositions which have to be negotiated. It took, when I was EU Commissioner, I think we had 54 single big issues to get over to do with financial services, to make a common market in financial services. And the single market, I piloted through the end of the Services Directive that my predecessor, Mr. Balkasi, had started. That became a very hot topic all over Europe, not in the UK or in Ireland, I say, but all over Europe. And it was watered down, maybe from the original purpose of Mr. Balkasi to start it, but that was in order to have some proper services directive. So therefore, you have to have some type of uniformity. And all of these, the factors that people haven't built in to the whole negotiation, when this stops on the 1st of January, it's going to be a different ball game for everybody. Unquestionably, Vicky is right. For Ireland, like our biggest neighbour, is where we trade most of our goods. As I say, now we add the EU in total, we trade more to the rest of the EU, but as a single place, the United Kingdom will be very simple. If you're in any type of business and you start off your local town as buying services, the place you're going to sell your goods next is in the local town. The next will be the nearest county and further around the county. It's the same with us in the United Kingdom and vice versa. The trade from the UK to Ireland is quite massive in quantity terms from the UK to Ireland. So therefore, it's a negative issue for both of us, but we've been smaller than the UK. It's quite a bigger issue for us. Now, if we were totally dependent on the UK as we were up to 1973, we would be wiped out. But that's no longer the case, luckily enough. So we're well diversified. But yes, it's going to be a negative, and we're only hoping that the extent of the negative consequences are going to be smaller, as small as possible, let's suppose.
Vicky, on the point of global trade and Charlie touched on the financial markets and financial services. It's that time of the webinar when I ask you to get your crystal ball out. What do you think the impact on the currency markets, which a lot of people watching the webinar right now will have an interest in? What's your view on how a no deal may impact sterling and euro?
I think in the short term, if there is a deal, then sterling would strengthen. We've seen already some recovery taking place, but if there is no deal, then I think we'll see quite a substantial decline. I mean, the thing to bear in mind is that over the longer term, nevertheless, even if there is an improvement in the short term in the value of the pound, we have lost huge amount of productive capacity. Other countries have too, but we had also lost over a period of time a lot of our productivity growth. So if you were calculating where we might have been in terms of output, if we had carried on with the productivity growth we had before the financial crisis, we might be 25% above where we are now, which is an extraordinary figure. It's been calculated by some people that it would be as high as that. Now, if your productivity remains low, if indeed having left the EU, we are a less attractive place for companies to invest in, which generally tends to boost productivity in an economy, then the likelihood is that we're going to be in for a lower growth environment than would otherwise be the case. So for the UK to remain competitive, it would need to probably have a weaker exchange rate. And I'm suspecting that after a while, the markets will realize that too. It was a little bit like the reaction when we voted to leave, and the reason why the pound fell was precisely for that reason. And if you look also at Brexit uncertainty, there are indicators now produced by the Bank of England and others show that that is a very important, has been a very important factor. We may still, with a deal, have a problem about the outlook anyway, in terms of the financial services in particular, and also the extra cost of doing business in Europe that are going to pile on and will make us more uncompetitive anyway. So there is that serious concern that we have to deal with, and the markets will have to deal with. What you've also seen is that there's been a substantial increase in the number of transactions, whether it's M&A or greenfield investments, that have taken place from the UK into the EU as a response to the vote to leave the EU. And whereas the rest of the world has slowed down in terms of its interest in Europe temporarily, we carried on from the UK, which does suggest that that trend, irrespective of whether there is a deal or not, will continue, because there are still going to be very substantial regulatory requirements, particularly in the financial service area, which will already have done, but will continue to encourage that type of movement to take place, whether it's funds, whether it's people, and that will, in my view, undermine what goes on in the UK. There are some issues about onshoring. There's quite a lot of discussion about perhaps bringing various parts of the production process, particularly manufacturing, back here, back home. There will be a certain element of that, but the chances of that being at all significant, given that we are still going to be in a globalized environment where, trade flows in a way that takes advantage of the most efficient production across the world, then we will still be bringing back things that were considered to be unproductive when they were done here before. So I'm not fantastically hopeful that that's going to be the solution to our problems.
Well, the same as in Ireland, like the way things worked out when we joined in 73, we had a lot of manufacturing industry here in Ireland that went by the wayside. The car industry went here. We had offshoots of all types, like the boot and shoe industry. All those, I remember all these places were in my own county, which I represent, and they all were eventually closed down over the next 7 to 8 years. But we compensated by having a lot of other industries, particularly in the services sector. And we have benefited somewhat. The Irish economy has benefited somewhat in the last 2 years by particularly financial services companies relocating to Ireland. Now, other places have done somewhat as well, or even better, in terms of Paris and Frankfurt. But like there has been, and they'll be coming from the UK, because the difficulties in trying to operate from London, as opposed to having an office in a place in Dublin or in Paris, you have access to the whole EU market. You asked a specific question about the currencies. When I was Minister for Finance, and before Ireland joined the Euro, UK did not join the Euro, as you well know. I used to, before I ever became Minister for Finance, I thought I learned an important lesson, which I abided by. I said that politicians shouldn't speculate one way or the other how currencies were going to go, because no matter what you said, you were just hitting a target. You shouldn't say this, because that's another target that the markets will hit. And I abided by that rule absolutely as Minister before we joined the Euro, because we didn't join and we didn't set our rate until a lot later in the cycle. We said late in 1999, and I don't have the same constraints on me now about the currencies, but I would agree with Vicky. I think the market in the short term certainly might go up a little, but generally the markets have built in the factors that are going to cover. I think the market at the moment, currency markets at the moment, have built in the fact they're betting that the UK, the EU are going to have some type of a deal. So I think it's in the price. Longer term, as Vicky says, but that depends on how the UK economy is going to go vis-a-vis the rest of Europe and the rest of the world. Because if you weak currency here, it must be stronger currency somewhere else, etc., etc. And that's what the markets will determine. So I don't think you can predict in the longer term as what's going to happen. But I think it's already in the price and the rates of exchange at the present time. The fact that there will be some type of a deal. Longer term, who knows?
Very, very good points. Just to build on the conversation that we've just been having then, and go a little bit deeper. What other broader business sectors do you think may be impacted if no deal is reached, and will some sectors be impacted positively, potentially? I guess the broad rule would be negative through no deal, but do you see any opportunities as well as what's the downside to specific sectors?
Well, just before Vicky comes in, let's say some of the smart thing anyway is that the only place I see immediate growth are in forward freight agents and customs officials and civil servants to deal with all this. Because, for example, in Ireland, we had sort of hundreds of thousands of officials who were expert in all these areas, and a lot of businesses up about freight forwarding and customs and tariffs, and people in the public service expertise. All that expertise is more or less gone. We still have lots of people in it, but they're not gone. So that's going to be a growth area, if you can call that type of activity economic growth. I think we have benefit and continue to benefit in the area of financial services. It will be negative for us in the short term to do with food. We are a major food exporting country. It's our main activity, employing tens and tens of thousands of jobs. We've been quite innovative in all this area. When I was a young man in the 50s, 60s, we used to listen every Wednesday evening to the cattle market price in Dublin, which were what bullocks were going to make and what cows were making, etc., because it was totally dependent on the UK. Now, the food industry in Ireland is a long way removed from live exports. It doesn't figure that much in Irish figures at all. But in their gigantic food operations here in Ireland, we are per capita the biggest exporter of food in the EU. So therefore, the fact that there will be tariffs will be a problem. But the fact that the delays, all businesses now you want just in time, must be produced there and then. So we're going to have all these trucks building up in the Irish ports, all these trucks in the UK. Now in the last 3 weeks, we've opened up a new place from Ireland to go to somewhere in France. But generally we have to go through the United Kingdom. So that's going to slow down activity. All these simple things like will make it's going to have a very negative impact. Hopefully in a year's time, if people start to work out all this, it may be somewhat better. But it's not going to be easy. It's not going to be like just click your fingers. We're out of the UK. The UK is out now. Things are going to be great. It won't be great for anybody for a long, long time, in my view.
Right. If I would then add to that, and I do agree with what's just been said. If you look at some of the analysis that has been done by governments and others in terms of what sectors will be affected, particularly if there is no deal, we've got to bear in mind that in the short term, there are going to be quite a lot of checks anyway, whether there is a deal or not, coming in force immediately, certainly for any goods that go out of the UK. And as you know, there's been this new sort of body set up to sort of monitor now what the issues might be in terms of flows of goods, vehicles, people, and so on from the beginning of next year, and see where the problems are. But there are going to be loads and loads of tests, as we know, checks and inspections possibly, and certificates that are going to be needed, and safety certificates and transport certificates, etc., which are going to affect every sector which is trying to export. But just remember that in terms of imports, certainly until the summer, the only imports from the EU that are going to need any proper certificates, if you like, are going to be substances. So, for example, alcohol, which are going to need to be declared, but very few extra checks. So the flow into the UK will be quite easy. There have been quite a lot of concerns that we might have shortages and prices will be going up and so on, but the government here anyway has said that that isn't going to be the case. And they've also, certainly not for the next 6 months, they've also announced a series of tariffs that they intend to impose if there is no deal. Those were temporary, and I think they will be revised a bit. But what you saw is that they weren't particularly high for a number of areas, certainly considerably less than had been the case before. And in a number of areas, those tariffs have gone altogether. So quite a lot of what will be coming in will be tariff-free. Now, we don't know at all what will happen on the other side in terms of, will they amend the tariffs? But as we know, the most favored nation tariffs are quite high in a number of areas, particularly for cars, dairy products, and so on. So the impact on trade, if you look at bits of the goods industry and how those might fare, have been estimated to fall particularly negatively on the motor industry. So it's motor services and transport generally, and a number of other interesting sectors, including strange sort of textiles and metal products, chemicals and plastic, and so on. But it also affects quite significantly food exports. I think, as Charlie was saying, quite a lot of what we produce is actually exported. Even what we fish is exported elsewhere. A lot of it is, of course, processed. But overall, what we see is sort of meat products and dairy products being affected, where, in fact, tariffs are very high in Europe. And then when we move from that and look at services, then yes, I think quite a lot of negative expectations for finance and insurance. I mean, remember, we're moving away from a situation where we have mutual recognition, where we can use a single passport, inverted commas, that is issued for services for any firm that is operating under Bank of England regulation here. They can export their services across. Of course, we still don't have a particularly, complete single market in financial services. We don't have a single market in capital markets, really. There isn't a single capital markets market across Europe, and that needs to be completed. There are different rules, stock exchange rules, there are different pension rules, and so on. But that is moving ahead. But what it does mean is, nevertheless, that all the freedoms that we had, including freedom of establishment, freedom to fly an aeroplane, possibly, without worrying. I mean, there are, again, quite a lot of studies that have been done as to where most of the non-tariff barriers would impact. So I already mentioned, of course, the financial sector, but air transport, very significant. Legal services will be affected. There are huge non-tariff barriers to operating in Europe if you're a third country. And then, of course, there's this whole area of data movement. And that, of course, matters a lot for financial sector companies. The thing to bear in mind, nevertheless, is that for basic finance, such as deposit and lending facilities, as a third country, you can arrange that country by country, individual country by individual country. So, the UK could strike an arrangement with any of the EU countries for its banks to be operating there, providing those basic services. But it also applies to investment services for retail investors. They can also do that quite easily, in the sense of agreeing with the particular country that they can be established there. So it's not all bad from that point of view, but it does make life considerably more difficult.
Well, I just tell you a funny aside that was featured on, well, it may not be a funny aside for some businesses, but on the Irish news last night, it brought up the issue of chips, fish and chips. Apparently, even though we're a food producing country, we import a lot of potatoes from the UK. Apparently, they make the best chips, and those potatoes make the best chips. So there was a snippet on the Irish news from the leading, a very prestigious brand of chips in Dublin. They're there for 107 years. Bordaks, for the man was saying, this is going to have a negative. We have to make arrangements because the potatoes we get, the best ones to make our chips, come from the United Kingdom. Now, that's only a small thing, as you might know. But all these other issues that Vicky has spoken about come into play, and it's kind of the single passport for financial services. That's been a boon, say, to the UK. Much to the chagrin, may I say, of people in Paris, and particularly in Paris, if not even Frankfurt. So there are all these other things as well to do, like the aviation, due to the single skies policy that came around as a result of the UK. Ordinary people are able to fly all around Europe for very cheap prices, primarily due to my very good friend Michael O'Leary and Ryanair, which has inspired other people. But the single skies policy was an EU initiative. The same, and I say just one point about why it didn't. I wasn't that totally surprised with the no vote in the UK. I would have probably said on balance, yes, might have won, but I wasn't. I was one of the few people in Ireland that said, no, don't be so sure about this long time into it. Because as someone who's been a practicing politician for most of my adult life, see, all politicians, whether in the UK or in Ireland, like to give good news, right? So therefore, if there's bad news, you want to blame it on somebody else. So if there are different regulations, rules, etc., you say, oh, we have to do that on account of the EU. It's a kind of a way out. But then you can't come along and a couple of years later and say, well, we want now you to vote for something in the EU because all the good things that happen, say like the aviation policy is able to allow cheap fares all over Europe and you go to your holidays in Spain 2 or 3 times a year. Ordinary people, like I'm long enough around to know when I was an Irish minister seeing the bill to fly from Dublin to Brussels, like it was hundreds and hundreds of pounds. Anyway, but competition has brought it down. So those are the kind of positives, and of course politics, same in Ireland, we blame the EU for the bad stuff, and we won't when the good things come along, we don't give the European Union credit. So that's what's happened down through the years. But all these other areas, I think there's a big negative for the UK and Europe as well. Say when political pressure comes on from a particular segment of industry or business to say, well, why don't you bring in special protections for us and increase the tariffs on stuff coming from wherever it is in Europe? That'll bring political pressure to do so, whereas previously you couldn't have done that. And I think that has not been factored in by anybody. And that will happen because segments come along and say, we're having pressure, we're losing business in such and such place in the EU, bring in tariffs or some rules or regulations on some financial services area which we didn't have before. And that's going to increase, and then there are going to be reciprocal negative arrangements on the other side, and you get into this tit for tat arrangements. Whereas we're all part of the bigger EU, you didn't have this didn't happen, or you didn't. You might have said to your population, the politicians, "I'd love to do this for you, this for yourself, but I can't do it because I'm not allowed to do this by EU law." That will no longer be the excuse, and I think that'll be a negative that hasn't been factored in by anybody into the equation.
Just as a final point, and thanks for all your views so far, supply chains are clearly going to come under pressure. In the event of deal or no deal, there's going to be some sort of pressure to supply chain, whether it's slight or extreme. In your views, how can businesses look to manage future risk in the current environment and given the pressure that will invariably come to supply chains?
Well, I think it's a serious problem for supply chains, which have already been hit, of course, by COVID. And that's been the concern all along, that Brexit is just going to add an extra dimension to this. And obviously, if the big firms that you're supplying are disappearing, first of all, and we've been hearing in the last few days of big companies that are going bust anyway, or are going into administration, even though, of course, some of those big names, retail names, are quite a lot of them are UK focused. But nevertheless, it has already led to quite an impact on suppliers. Now, those suppliers, of course, are also involved in providing goods and services, not just directly to companies in the EU, but through those big firms, whether they're manufacturing firms or others, actually act as a sort of indirect suppliers to the rest of the EU.
Yes.
And that is forgotten very often when you look at the trade statistics, that there are loads and loads of domestic oriented firms that provide the supplies that are needed to companies in the UK, which then export elsewhere. And if that chain gets reduced, and there is also this increasing consolidation going on, cost cutting and so on, which means the suppliers are losing out anyway, then it's a serious issue for many of them. The only way, of course, that people are justifying perhaps leaving and still, doing reasonably well is that a lot of IT has taken over in terms of the way in which you do your exports and your links with other companies elsewhere. But if there are tariffs even for intermediate goods, as there are, then that's going to be a problem, even if you're supplying one bit to another company in Europe. Let's say you're in the manufacturing sector, where, of course, the German car manufacturers are relying quite a lot on supplies from here and so on. Then you are, possibly able to do it, but there is still going to be a tariff there. If there is no tariff, then it's clearly easier. So the figures, or rather the sectors identified before, they were very much the ones that would be affected under no deal. Obviously, with a deal, what is understood is that there will be no tariffs, and that makes life considerably easier. But what you then have is you have to prove the rules of origin, the safety standards, and so on, that are going to be absolutely essential for any trade that anyone does with the EU. And that, of course, means extra costs to suppliers. And then, of course, competition will increase from other parts of Europe because they can do the same thing without the extra costs attached.
Well, apart from all that, and apart from the tariffs and all those particular issues, the fact that things will slow down, the fact that you, at the moment, if you remember the EU, and really, like you said, there's a big demand for any particular product or service, really overnight that you'll be able to receive it. That won't happen. There'll be the fact that will slow down things will be negative for all of the economies, the United Kingdom and Ireland in particular. We are the two island nations here, surrounded only by water. So therefore, in order to get goods in or goods out, we have to you have to leave the island of Ireland or leave Britain. So therefore, the fact that you have to fill forms, go through inspections, add tariffs, all that is going to slow down economic activity, which is a negative. So therefore, it's a no win. And even if there's some type of deal, it will not be the same as has been before. Like as other people have pointed out, you can't leave the club and expect then the next week that you have all the facilities of the club and all the benefits that brings. That won't happen. So therefore, all in all, it's a big issue for Ireland because we are a trading nation. We only have a population of the Republic 4.75 million and Northern Ireland about 1.7 million. So we're very small in terms of Europe and small in comparison to the rest of the UK also. So therefore, it's just it's all these things are going to. It has to be negative, and this goes less economic activity. Then, on the other hand, I'm a bit of an optimist, and I say, well, down through the centuries, a lot very bad things have happened, and then in a period of time, people recovered and economies recovered, and we'll have to take the bright side. I mean, a decade's time, things we'll have been able to get over these particular difficulties, and hopefully things will be able to proceed at pace.
Can I just add one quick thing? Even if there is a trade deal and no tariffs, in terms of any suppliers being able to access the market, what we need to take into account, of course, is also, as I said earlier, the non-tariff barriers. So the impact on logistics is going to be very significant, on distribution. More generally, we've been hearing quite a lot about the problems that road hauliers are going to have getting things across, because, of course, they need lots of documentation to allow them to do that, a transportation export documentation. And we've also heard about the problems in terms of the speed with which anything can be sent anywhere in the future, tariffs or no tariffs. And that's going to be a really significant part of, do you remain in any way competitive in the future? So, but there are all these, non-tariff barriers that are going to be there. And one of the worries that I have is that at present, of course, anyone who wants to send anything, or certainly a road haulage firm, can then pick up anything from Europe and bring it back or deliver it somewhere else. Exactly. Are all these things going to continue or not? And there are at present all these discussions taking place in terms of trade and services and what can happen. And we have very little information as to whether any of this is done. Remember, there are 11 different areas that are being negotiated at present. We're focusing very much on tariffs and on fisheries, but there is a lot else, and including, of course, a very important, again, which I touched on before, which is the sort of data exchange, the extent to which you can actually use information from across the border to even do, the whatever supplies you may want to have arranged between you in the UK and a customer in the EU. And for financial services, it can be a nightmare in terms of where do you hold that information about, let's say, all the pension contributions or the pension payments that UK citizens in other countries may be getting in the future, and how do you get all of that done through the system when perhaps the data transfer rules change. So there is a lot there, and here we are, not very many days until the end of this period of transition, when a number of these things are not clear, and that's why there's quite a lot of discussion now about having an extra implementation period so that firms can get ready, suppliers can get ready, and that as a result, perhaps the fallout isn't as big as it might otherwise be.
Just one thing, can I ask Vicky a question? Do you think it's politically possible for the UK in the negotiations to concede that particular point and need a little bit more time? Would not be portrayed particularly politically in the UK that the government had lost there?
No, I think the way to do it probably is because it does take time for the EU in particular to possibly to agree all this, particularly if it's a complicated arrangement. If it's a very thin deal, it might just happen with the European Parliament voting for it. But otherwise, some countries may want to have, a look at it themselves. It hasn't been clear at all whether there is a need for the deal to go to individual countries and then you have unanimous approval, as it happened with some of the other trade deals.
Yeah, I know. I understand.
As we know.
Yeah, how would it be traded in the UK, do you think?
No, well, what I thought was that perhaps, therefore, if it takes a bit longer for the European Parliament to approve it, because there isn't very much time available, they're talking about a special sitting maybe on the 28th of December. If it takes a little bit longer, so what you could do is use that excuse, so to have it sort of approved in the EU to allow for a little bit more time for implementation of any of this. So it could be a way around. In other words, a triumph, agreement, a deal, but actually in terms of affecting businesses, which we know on already, then you can leave it to a little bit later in terms of when the implementation starts, and maybe even have some agreement that some of what the EU is supposed to start doing in terms of checks from the beginning of January might be delayed for a little bit longer to fit in with what the UK intends to do, which is leave it until July.
Thank you, Vicky, and thank you, Charlie, for that fascinating insight on our webinar today. I'm sure the conversation could go on for a lot longer, but unfortunately our time for today is up. So I really want to thank you both for that fantastic insight into the ongoing Brexit situation. Moneycorp Bank exists to help businesses, people and banks thrive internationally. So if you're a business, an individual or a bank, and you wish to have us assist with your international payments or to look after your foreign currency exposure, then please get in touch. Likewise, if you enjoyed the webinar today, which I'm sure you did, please like and share on social media. Don't forget to sign up to our next webinar, which will be hosted by our Head of Risk, Andrew Harrison, alongside Martin Clements on cyber risks, past, present and future.